Hello, everyone. This is Chris Schwartz with KBID Online Auctions. Today, we're going to bring you a little continuing education on maximizing financial success, some accounting strategies for auction companies with Booked and Balanced accounting firm out of St. Cloud. We have Cinda Lovato with us today. Thank you so much for joining us. A little bit from what I know about you is that you used to be an affiliate with KBID, I think in about 2015. And then you've had accounting experience for over 20 years. So not only do you have the accounting side of things, but you also have the real world auction experience. So you've ran both sides of the equation. So we thought this was a great time to kind of bring you in and get some insight from you, what people are struggling with on the accounting side. I know some people just want to be super hands off with it, and it can be overwhelming. So we're here to just answer a few questions on where people get caught up. So
Sure.
if you want to introduce yourself a little bit, and then we'll jump right into it.
Sure. Yep. Like you said, we were a KBID affiliate. My husband and I were from actually 2013 to 2016. We also had a consignment store for 1 year. So we did that together. I have my accounting degree from St. Cloud State University here in St. Cloud. And like you said, I've been working in the accounting area for over 20 years now. So I have a variety of different industry experience, but auction companies being one of them since we had our own firm. So yeah.
Cool. And you do bookkeeping, you do payroll, you do a lot for different clientele?
Yep, I do. Yep. And a lot more. Yep. So.
Well, that'll be helpful in the topics that we discussed today. We took some polls and got some input from current affiliates on what they wanted topics they wanted to hear about, and then just some other, baseline or general knowledge things that we wanted to go through. And with that, we have our agenda, understanding some of the unique needs of auction companies. I'll let you kind of go through what we're going to talk about today here a little bit.
Sure. So the agenda that we're going to go over today is just understanding the unique needs of auction companies, the importance of having effective accounting for auction companies. We're going to do an overview of accounting methods, key financial statements, tracking revenue and expenses, sales and use tax compliance, and then payroll and employee considerations, and including how as an owner do you get paid, reporting compliance, and then collaborating with a professional accountant. And then we'll have like a little Q&A session at the very end of a couple things that might not have got covered.
Yeah, these are some big topics, so obviously we can't cover everything, but you know, like we said, just some key points and things that we think would be valuable for members of our affiliate network. So thanks again for putting this together and joining us. We're going to give out all your contact information at the end if anyone is looking for bookkeeping help or needs to dive deeper into one of these topics. Again, we thank you for joining us.
Sure, no problem. So understanding the unique accounting needs of auction companies, when to recognize revenue, and also the 1099-K reporting part of that, cash transaction over $10,000 reporting requirements, because some auction companies might have to be doing that reporting. We're going to talk about consignor commissions, contractors, employee or employees. What's the difference? When is a person an independent contractor and when are they an employee? And then paying owners. How do you get paid as an owner? And then shipping. This is kind of a big one for a lot. When you're shipping to multi-state customers, what kind of sales tax compliance are you required to comply with? So we'll talk about those as well. So the importance of effective accounting, there's a number of reasons why it's important to have accurate and timely financials. The first one is financial management. So accurately and timely accounting helps auction companies manage their finances effectively. It involves accurately recording and organizing of your financial transactions, such as your revenues, your expenses, assets and liabilities, properly recording and calculating your sales and use tax, your depreciation and amortization, any gains or losses you have on the sale of or disposal of assets, and generating financial statements and much more. This allows a company's management to have a clear understanding of its financial position, performance, and cash flow. Accurate and timely accounting enables informed decision-making and facilitates strategic planning. Number 2 reason is financial analysis. By using effective accounting, it allows auction companies to assess their financial performance over time. By analyzing financial statements such as the balance sheet, the income statement, and the cash flow statement, key financial metrics such as profitability, gross profit margin, and overall financial health can be calculated and analyzed using financial data. This helps management and owners to identify areas of strengths and weaknesses, make informed decisions, and implement strategies to improve your overall performance as a company. Number 3, cash flow management. Effective accounting helps auction companies manage their cash flow efficiently. Cash is the lifeblood of the business, and lack of cash flow is the number 1 reason for business failure. By monitoring income and expenses, the company can determine the timing of payments and receipts. This allows you as an owner to plan your operations, to meet your financial obligations, and maintain a healthy cash flow position. It also helps to identify potential cash flow issues in advance, enabling proactive measures to mitigate them. Number 4, business planning and decision-making. Accounting data plays a pivotal role in business planning and decision-making for auction companies. It provides insights into your revenue streams, their costs, profitability, and your financial trends. This information assists you in setting realistic goals, budgeting, pricing commission structures, allocating your resources appropriately, and to plan for future growth. It helps management make informed decisions based on financial analysis and projections. By tracking your financial performance against budgets and forecasts, companies can identify discrepancies. It enables you to take corrective action and maintain a financial stability. Compliance, regulation, and taxation. Companies are subject to various regulations, tax obligations, and reporting requirements. Effective accounting ensures that compliance with legal and regulatory standards such as federal and state tax laws, sales and use tax reporting and filing are complied with. Accurate and timely accounting records facilitate the preparation of financial statements and tax returns, reducing your risk of fines, penalties, and legal issues. And finally, bankers and investor confidence. If an auction company seeks to have financing from a bank or investors, the accurate accounting is crucial for instilling confidence in bankers or potential investors. Your accurate and reliable financial information enables the bankers and investors to evaluate your company's financial stability, growth potential, return on investment, and withstands an audit if required in order to get the financing or investments that you are trying to get. Well-maintained accounting records can also facilitate due diligence processes during investment negotiations. In summary, effective accounting is vital for auction companies to manage their finances, make informed decisions, obtain financing, and to comply with regulations and tax obligations. And it plays a crucial role in financial management, financial analysis, management of your cash flow, and business planning.
Mm-hmm. Well, I mean, money is the name of the game, right? In any business, especially this business, you can get so busy and money's coming in and out of your account. But if you don't know if you're profitable or where your profit's coming from, how can you make decisions that are going to grow your business going forward? I think that's the bottom line of all of these subjects that we're going to talk about, is how do you make better decisions as a company that are going to help your bottom line? And make sure that you're looking back a month or two, and would I do that auction again, or what would I do differently as far as moving forward? So that's
right.
Great.
Yeah. If you don't know your numbers, you're not going to know how to move forward and what you should be doing. So it's very crucial that you have your accounting records up to date so that you can make those decisions. Otherwise,
you-
you're just running your
Yeah.
company blindly.
And if you can't, you get the people around you that can, or you hire people that can. do
Exactly.
these.
Yep.
Cool. So we're going to jump into, I'm guessing a lot of people have taken basic accounting classes or have read up on accounting, and just talk about the basic accounting methods that most people are familiar with.
Right. So there's two basic ones. There's also like hybrid ones as well, but we're just going to talk about the two main ones, the cash method and the accrual method. The cash method is used when your income, you report your income when it's constructively received. So when it hits your bank account or you have access to it, that's when you report it. Expenses are generally deducted when they are paid, and it's the most common method used by small and mid-sized businesses. The accrual method, the difference there is your income is reported when earned, not necessarily paid. Sometimes you may earn it, but it's not paid till a later time period. And it's same with expenses. You may incur it, but you may not have paid it. But under the accrual method, you book the expense when it's incurred, not when it's paid. The accrual method is the matching concept under GAAP, or generally accepted accounting principles. And it's required of corporations and partnerships with an average gross receipts of 26 million or more over 3 years, and also with inventories and 26 million of gross sales as well. You choose your accounting method for your business when you file your first income tax return. And then you have to, if you wish to change it, you generally have to get IRS approval to change it from one method to the other. And like I said before, most businesses most auction companies will probably be using the cash method. If you do own more than one business, you can use a different accounting method for each business if the method you use for each clearly shows your income, but you must keep a separate and complete set of books and records for each business. And then the other thing I just want to mention, if you're using an accounting software, make sure your accounting software is set to the proper method that you are using. Sometimes they default to the accrual method. So you want to make sure if you're on the cash method that you have your accounting software set to the cash method and not the accrual method, especially when you're ready to file your income tax returns.
Mm-hmm. Well, I think you made an important note there, because I know a lot of our affiliates have their hands in different businesses. So, they may own 2 or 3 or more businesses, but making sure to keep those books separate and not commingling funds or reporting across different businesses will just give you a clearer picture of,
right,
again, your financial position.
Yeah. So we're going to talk about some key financial statements pretty briefly. They're going to be pretty simple about what we're going to talk about them, but I just wanted to do an overview on them just to kind of give people that don't have a lot of knowledge about it just a overview of each of the statements. So the 3 key financial statements that are used by small businesses to mid-sized businesses are the balance sheet, the income statement, also called the profit and loss, or sometimes just called P&L, and then the statement of cash flows. And then we'll talk about the balance sheet. So the balance sheet is a summary of the company's assets, what it owns, such as buildings, equipment, inventory, and cash. Its liabilities, what it owes to creditors and banks, and then its equity, the money invested by the owners or shareholders, plus profits or losses, as of a final moment of an accounting period. For example, a balance sheet dated December 31st summarizes the balances in the appropriate general ledger accounts after all transactions up to midnight of December 31st have been accounted for. Why is it called a balance sheet? Because the assets need to equal the liabilities plus the equity. The balance sheet paints a picture of the company's financial position or its net worth at a certain point in time. Subtract the liabilities from the assets and you get your net worth, also called equity. The use of double entry accounting keeps your balance sheet in balance. I'm just going to give a couple of examples. When a company borrows money from a bank, the company's assets will increase and the company's liability will increase. Debit the asset and credit liabilities. When a company uses cash to purchase land for a new warehouse, the asset land increases and the asset cash decreases. Debit land, credit cash. When a company earns $5,000 by providing auction services, the company's assets, either your cash or your accounts receivable, will increase. So you debit cash or accounts receivable and you credit at sale. So its net income on the balance sheet will increase. This is done by accounting software. Net income on the balance sheet is increasing because revenues will cause an increase in the amount of net income on your income statement. The increase in net income on your income statement causes the increase in net income on your balance sheet. The amounts reported on the balance sheet are summations of the ending balances in the many asset, liabilities, and owner equity accounts. The summarized amounts are presented in the following 3 sections of the balance sheet. The first section is the assets, and those contain your current assets such as cash, accounts receivable. Long-term investments is any investment that's greater than 1 year. Property, plant, and equipment. So if you have any trailers, vehicles, a building, etc. Intangible assets, that would be like copyrights, patents, etc. And then other assets. The second section is your liabilities. Current liability is any liability that's due under 1 year, and then non-current liabilities is any liability that is due over 1 year. And then owner's equity is your section 3, and the actual accounts names will vary depending on the type of entity the company is, but can include any of the following: capital account or /stock if it's a corporation, paid in capital, retained earnings, net income, owner's withdrawals, stockholders, or owner's equity. I'm going to talk about retained earnings just a little bit. Retained earnings is your cumulative amount of company profits and losses from when the business opened, or alternatively, when it started keeping financial statements, to the end of the prior year. Current year net income or loss will show in the net income account, and when the books are closed at the end of the tax year, it will close out into the retained earnings account. The net income account will then start out at 0 on January 1st, or the first day of its tax year if it's not January 31st.
So in regards to like an affiliate company, are there any tactics that they'd want to be aware of as far as retained earnings long term, or does it really just depend on their situation?
I'm sorry, I didn't quite understand your question.
Would there be, I know, towards year end, people are trying to potentially purchase equipment or purchase items to, draw down their earnings for a year. And that way they can, lessen their tax liability.
Sure.
Are those things that someone like you would help a company kind of plan out for?
Sure.
Year after year?
Mm-hmm.
Okay.
Yep. So all of that depends on really where the company's at in terms of how much money it's making. If you're at a net loss or if you're not making much money, you're not going to want to expense as much of that. But if you have high income and you're trying to reduce that down, purchasing assets and then doing like a Section 179 deduction can be beneficial in helping you reduce that net income.
Mm-hmm.
Okay, so we are going to talk about the income statement, also called the P&L or profit and loss. The income statement is one of the main financial statements of a business. It measures the company's financial performance. The income statement reports revenues, expenses, gains, losses, and the resulting net income which occurred during the accounting period shown in its heading. Typical periods or time intervals covered by an income statement include year ended December 31st, 2022, 9 months ended September 30th, whatever tax year you're in, month ended August 31st, whatever tax year. Unlike the balance sheet, the income statement starts over at 0 at the beginning of the company's tax year. The statement is divided into operating and non-operating sections. The operating section includes revenue and expenses that result from the normal business operations, like the sale of products or services, so your auction services. This section tells you a great deal about how the company is doing. The operating section of the income statement will be the largest section of the income statement. The non-operating section highlights revenues and expenses that come from other sources, such as the sale of company assets, and is typically a very small segment of the income statement and will not even appear on the statement if there were no such transactions. Neither of these terms are typically printed out on the income statement, they are just assumed. Let's discuss the operating section. This section starts out with revenues or sales. Both mean the same thing, just a different word. Some companies choose to break out their revenue sales streams out by type. I recommend this because it can provide valuable information as to which revenue stream brings in the most revenue. You can compare it to its direct expense to determine that revenue stream's profitability. You can then make an educated decision about that revenue stream. Should you focus on that stream or should you remove it and concentrate on something that's more profitable? An example would be if you sell your own inventory and you also sell consignor inventory. I would have a sales account called our inventory and a separate sales account called consignor inventory. Likewise, I would have a separate cost of goods sold for each of these as well. The next section under the operating section is the cost of goods sold, often abbreviated as COGS. This is an expense section that is directly attributable to the cost of production of the products you produce or to the service that you provide. Since this webinar is directed to auction companies, I like to use expenses I would expense to cost of goods sold for an auction house. Payments made to consignors, inventory if you have your own inventory that was sold, shipping fees for auction items sold and shipped to customers, buyer's premium paid back to KBID, DMV/DNR fees paid, wages and the related taxes and benefits paid to employees for work on the auction that you can directly tie to the production of the auction, such as taking pictures, lotting, setting up, writing description of the lots, auction pickup, etc. Expenses that would go into the general and administrative category would include management and admin salaries or wages, their payroll taxes and benefits, advertising and marketing expenses, dues and subscriptions, information technology fees such as computer equipment and access, software, legal and professional fees, office supplies, lease expense, utilities, insurance, depreciation expense, etc. The non-operating section includes any interest income earned and gains or losses on the sale or disposal of your assets, equipment, such as the sale of a company-owned vehicle, a trailer, a building, etc. There's a lot more that we can cover regarding financial statements, but due to time constraints, we're going to stop here.
And here's a example showing the differences between a balance statement and a P&L or income statement, correct?
Yeah. So these are just very, very simplified versions. Obviously, your balance sheet and income statement are going to have more categories than this, but just due to the lack of room on here, I just made them extremely simple in these examples. So let's just look over the balance sheet real quick. So you're going to see ABC Auction Company is going to be the title. So that's going to be your company name. Then the title of the statement, balance sheet, and then the balance sheet is as of January 30th, 2023. So this ABC Auction Company has assets, current assets of $190,835. Its property, plant, and equipment total is $275,350 for a total assets amount of $466,185. In its liabilities, it has current liabilities due of $12,273. It has long-term liabilities of $202,000, $575, for a total liability amount of $214, $848. In its equity section, it has paid-in capital of $5,000. It has owners' distributions of $12,000 that was distributed to owners of the company. So this would be a corporation, an S corp perhaps. Retained earnings of $56,812. So again, that is the cumulative profits and losses from all prior years since a balance sheet has been calculating or been used. And then the net income is the current year income of $201,525 for a total equity amount of $251,337. So just looking at this balance sheet, you can look that this company has made some substantial growth in its current year. And then if you look at the total liabilities and equity of $466,185, if you look and compare that against the total assets, you will see that both of those match. So again, assets equals liabilities plus the equity. So in a nutshell, that is a balance sheet.
Mm-hmm.
We're gonna move over to the income statement. So again, on top is the company name, the title of the statement, income statement, or it could be also called profit and loss. And it's for the 6 months ending June 30th, 2023. So this income statement is from January 1st, 2023 through June 30th of 2023. Revenue, it has sales of consignor inventory of $427,322. It has sales of the business inventory of $99,573 for a total sales revenue of $526,895 so far this year. And its cost of goods sold, which is an expense, the cost of goods sold of consignor payments is $277,760, and you can directly check that out against your sales of your consignor inventory to see if that's a good revenue stream or not. And then cost of goods sold, our inventory, $9,958. And again, you can compare that against your own inventory sales. And it looks like, yeah, buying your own inventory makes financial sense. Total cost of goods sold is $287,718. And the gross profit is $239,177. Gross profit is your total sales, and then you subtract your cost of goods sold from that for gross profit. And then you have your general and administrative expenses. So far this year, advertising and marketing expenses have been $5,321, bank fees of $60. They have depreciation expense of $1,376, legal and accounting fees of $21,895, lease expense of $9,000, for a total general and administrative expense amount of $37,652. You subtract that from your gross profit and you get a net income of $201,525. And then you'll note, if you look at that net income, that flows over to your balance sheet. So those two match. Mm-hmm. So the net income on your balance sheet should total your net income on your income statement.
And one thing I found interesting in our talks previously is that sales tax is not counted as a cost of goods sold, correct?
Correct. That's the one item that you do not include in your sales. And then you also do not include it in as an expense. It's just strictly a liability that you collect and then remit. So it does not, should not hit your income statement at all. It'll only be on your balance sheet.
Yeah. Okay.
Yep. Yep.
Cool.
Okay, we're gonna talk a little bit about tracking revenue and expenses. So we're gonna talk about a little bit about revenue recognition, and kind of like what Chris just said about the sales and use tax. We're gonna talk a little bit about that. So as we previously discussed, revenue is reported based on the accounting method the company chooses. So if the company chooses accrual, then the revenue will be reported when it has been earned. And when the company uses the cash basis method, revenue is going to be reported at the time it has been constructively received. It is important that a company report all income on your tax return, even if that same amount gets paid to another vendor. There is some controversy in the auction world that if receipts from a sale go into a trust account or will be paid to another vendor, you do not need to report it as income. I do not recommend this at all. My advice to you is if your company's name is on the account, unless the funds are truly restricted, all payments received into it, you should be reporting as income under gross receipts on your tax return. Not reporting that income may find you on the wrong side of an audit. Simply report the payments made to others and expenses, and it will net out the same anyway, and you will find that you can sleep a little bit better at night. The only exception to this is the sales tax. Let's talk briefly about the new reporting 1099-K requirements. Effective on January 1st of 2023, all credit cards, payment apps, and online marketplaces are required to send out a 1099-K when the gross payment amount is more than $600. If you accept credit and debit cards, you probably have already received these from your payment processor in the past. The biggest change is the dollar amount threshold and the number of transactions have been removed. The amounts reported are reported by month, so be sure to reconcile your gross credit card receipts received by month to your statements. I'm defining gross by the credit or debit card amounts charged before the credit card fees are deducted by the credit card processor. So make sure you're including the gross amounts and not the net after the fees into your gross income. It is also to my understanding that the State Department of Revenues also receive these reports from your credit and debit card payment processors, and they reconcile these amounts to the sales and use tax returns filed by your business. So make sure your sales and use tax returns filed are accurate and include the gross amounts received. Be sure to also include all amounts received by cash, check, and other payment methods as well. When reporting income, make sure that every single incoming penny, except for the sales tax, is reported to gross income. Also accepted are interest earned and capital gains, such as the sale of an asset. Those are reported separately under other income in the non-operating section of your income statement. Sales tax, interest earned, and capital gains are the only items that should not be reported under gross income. My motto is, if you receive it, it's reported to an income account unless it is sales tax. Recording expenses. As previously discussed, under the accrual method, expenses would be deducted when incurred, and under the cash method, they will be deducted when they're paid. Because I'm a numbers junkie, it can be a useful tool for evaluating income streams. I personally like to break out all cost of goods sold expenses. For example, our inventory cost of goods sold will be separately stated from the consignor inventory cost of goods sold, buyer's premium, credit card buyer's premium, shipping, and DMV/DNR fees are all separately stated. This does take more work, but can provide useful information. By breaking these expenses out, I can evaluate my expense to its corresponding revenue. This enables me to determine if that revenue stream is profitable and enables me to make an educated decision about them. So let's talk more about deductible expenses. According to the IRS, to be deductible, a business expense must be both ordinary and necessary. An ordinary expense is one that is common and accepted in your field of business. A necessary expense is one that is helpful and appropriate for your business. Let's go over some expenses that may be of interest. Startup costs. Business startup costs are the expenses incurred before your business operations begin. They generally include travel, surveys, legal, organization costs, etc. You can deduct up to $10,000 of business startup costs and up to $5,000 of organizational costs, but these amounts can be reduced if the costs exceed $60,000 and $50,000 respectively. The balance would need to be amortized. Depreciation. We will very briefly discuss depreciation. Note that I am giving very basic info and there will be many exceptions. The instructions for depreciation is 111 pages long, plus there are additional guides in addition to that. So I'm not going to be able to cover everything. You can depreciate most types of tangible property except land, because land is not depreciable, such as buildings, machinery, vehicles, furniture, and equipment. You can also depreciate certain intangible property such as patents, copyrights, and computer software. In order to be depreciable, the property must meet all of the following requirements. It must be property the company owns or you own if you're a sole proprietor. It must be used in your business. It must have a determinable useful life, and it must be expected to last for more than 1 year. Businesses set a threshold on the dollar amount to be depreciated, some up to $5,000 if the company has a written policy, or $2,500 if the policy is unwritten. You will need to elect de minimis safe harbor to your tax return if you write off any item $2,500 or more under these policies. Note that it may not be beneficial to your company to write off these larger dollar amounts if the company is making very little money or has a net loss. It may be better to add them to the balance sheet as an asset and depreciate them over a longer period of time. If you use property for business and personal purposes, you can deduct depreciation based only on its business use percentage. You must keep records showing the business and personal use of the property. You place property in service when it's ready and available for use. When the depreciable property is idle, continue to depreciate it or you will lose your depreciation expense. You stop depreciation when it's permanently retired from service or when it's fully depreciated. You'll keep the asset on your books until it is disposed.
Cool. And I think, one really important part up in revenue recognition, especially with a lot of our affiliates utilizing Square for credit card payments, is that once the money hits their account, Square deducts their credit card fees off the top. So, if you want to stay off the radar of sales tax audit, potentially making sure that your numbers match for the gross amount and not just what you've collected less the Square fees when you're reporting that. So I think that one is super important, especially because I think 75%, 80% of our affiliates utilize Square, and I know that that's how they handle credit card fees, is they take them off right off the top.
Right. So make sure you're doing that gross amount and not the net amount, because again, the IRS is actively tracking that, and you're going to, at some point, very likely be seeing an audit in your future if you are only recording the net amount in your gross income. So that's one thing that they're definitely watching. Yep.
And you're still notating or seeing the credit card fees as an expense. It's going to be the same amount once you get down to it. It's just you're doing the gross and then you're expensing the credit card fees, so you still get the same net amount. It's just how you record it and making sure that that's matching up, because Square is sending that to the Department of Revenue. So you want to make sure what you're telling them is accurate. So
exactly. Yep. And that's really the reason for the 1099Ks that they're doing, is they are ensuring that you are reporting the gross income. So make sure you're doing it properly.
Great. Here's a big one. I know, a lot of what we do revolves around travel with our vehicles. We have employees that are using their vehicles as well. So how do we expense vehicles? Is it via mileage only? Are there other options that we can do?
Yeah, so I'm going to go through that pretty thoroughly, I think. So obviously, there's going to be some exceptions to this as well, but I'm going to give you a lot of information on this so you can make educated decisions on how to go about it. So mileage and vehicle expenses is one that very often questioned, like you said. So first thing we're going to do, we're going to define a couple of terms. The first term for our discussion is the term vehicles, which the IRS defines as a four-wheeled car, van, pickup, or panel truck made primarily for use on public roads, and its unloaded gross vehicle weight is not more than 6,000 pounds, and it's not modified anyway. And then the second term is owned. It is considered owned if the company is a corporation and the vehicle is in the company name, or if you are a sole proprietor, it can be your personal vehicle in your name. It does not need to be in the business name if you're a sole proprietor. When you use a business-owned vehicle, you can deduct the costs of operating and maintaining it. There are two ways to calculate your vehicle expenses, either your actual expenses or the standard mileage rate. If you have a fleet of vehicles, which the IRS defines as owning or leasing 5 or more cars or vehicles that are used for business at the same time, then you must use the actual vehicle expense method for all of your vehicles. So if you have 5 or more vehicles that you're using at the same time, the IRS requires that you use actual vehicle expenses. Now, if you have 5 or more, but you're not using them all at the same time, you can use the standard mileage rate if you wish. But they cannot be used all at the same time. So if you're using one for a couple months and then you use a different one later down the road and you're no longer using vehicle 1, that would not be included in the count. So it's if you're using 5 or more at the same time. If you have 5 or less and are not using them at the same time, then you can take the standard mileage rate. You must choose the standard mileage rate the first year the car is available for use in your business if you want to use the standard mileage rate in any later year. If you use the actual vehicle expense method the first year, then you must use it in all later years. However, for vehicles the business owns or the sole proprietor owns, if you use the standard mileage rate in year 1, then you can take either method in later years, whichever method gives you the greatest deduction. If you want to use the standard mileage rate for a car you lease, you must use it for the entire lease period. With both methods, unless you use a vehicle for 100% business use, you must track your business use versus personal use. I highly recommend either using an app or the old-fashioned pen and paper method, which is my favorite personally. Use a notebook or attach the paper to a clipboard and with a pen, and then get in the habit of writing down the info each time you get into your vehicle, or use your app every time. The information should include the date, the beginning mileage, the ending mileage, the total miles driven, and the purpose of your trip. Track only your business use mileage. Get in the habit of turning it in monthly or each time you fill the page up to your bookkeeper or accountant. You will also want to know the mileage at the beginning of the year on January 1st and on the last day of the year, December 31st of each year, and also the vehicle information. For example, 2017 F-150, because these are required information on the tax return. If you are taking actual expenses, you must keep additional adequate records to prove your deductions. Documentary evidence includes receipts, canceled checks, credit card receipt, etc. Note that a bank statement or a credit card receipt in of itself is not considered documentary evidence. If you get audited, they will throw that out if you don't have your actual receipt. It must include the date, amount, place of purchase, and the essential character of the expense, such as number of gallons and price per gallon, or the type of work that was completed on the vehicle, along with the vehicle description of product, purchase, etc. When using the standard mileage rate, the current rate per mile for 2023 is 65.5 cents per mile. This does change annually, and sometimes the IRS has been known to even change it mid-year. When the vehicle is owned by the business or sole proprietor, you can, in addition, also deduct registration fees of the vehicle and parking fees and tolls. For actual expenses, you can deduct depreciation or lease amounts, licenses, gas, parking fees and tolls, garage rent, registration fees, repairs and maintenance, tires, and insurance. If you change to actual expenses method in a later year, but before your car is fully depreciated, you have to estimate the remaining useful life of the car and use straight line depreciation for the car's remaining estimated useful life, subject to depreciation limits. Note that parking fees to park your car at your place of work are not deductible commuting expenses. You also cannot deduct commuting expenses or mileage. You cannot deduct any cost of driving your vehicle between your home and your main or regular place of work. These costs are considered commuting expenses and are non-deductible. However, if you work in two places on the same day, you can deduct the expenses from the first place of work to the second place of work. Both advertising on your vehicle and hauling tools or instruments in your car does not make it business use when you're commuting or using it for personal use. It must be driven for bona fide business use. If you have a home in an office in your home that qualifies as a principal place of business, you can deduct your daily transportation costs between your home and another work location in the same trade or business. You may also pay your employees reimbursement for their travel expenses. There are several ways of doing this, but the standard mileage rate is the easiest and is not taxable income to them, and it is a deductible expense for the company. Because there are too many variables to say one method is better than another, I highly suggest speaking with an experienced accountant to determine which method would be the most beneficial in your company's situation.
It sounds like there's a lot to consider there.
There is, yeah.
Between the two, and which one makes the most sense to you. But I would be the opposite of you. I would be on the app side of things if I had to track mileage and where I'm going and why I'm going there. Luckily, I don't have to at this point, but yeah, good information there on each way to track expenses for vehicle usage.
Yep. As long as you're tracking and have access to it when you need it, that's all that matters. So whatever your preferred way of doing it and whatever works for you is the best way to do it.
Cool. Yeah, and I know a lot of our affiliates fall into this next category as well. They have a home office, they office out of their house, and how can they, figure that into their business, their accounting? How do they factor that in?
Yeah. So we're going to discuss who qualifies for the deduction, the definition of home, qualifying for the deduction, and basic instructions on how and what items can be included to calculate the deduction. So who qualifies for the deduction? The deduction is available to a self-employed person. In other words, you are a sole proprietor and you file your business income tax return on a Schedule C of the 1040. If you are a partner and the use of your home resulted in unreimbursed ordinary and necessary expenses that are trade or business expenses under Section 162, and that you are required to pay under the partnership agreement, you may be eligible for the deduction. If you are an employee, you are not eligible for the deduction. For an example, if you are an owner of an S corporation. So it's only available if you are a C Corp or potentially if you're a partner in a partnership. The definition of home. The term home includes a house, an apartment, a condo, a mobile home, a boat, or similar property which provides basic living accommodations. It also includes structures on the property such as an unattached garage, studio, barn, or a greenhouse. Qualifying for the deduction. To qualify to deduct expenses for business use of your home, you must use your home, 1, exclusively and regularly as your principal place of business, except when you use part of your home for storage of inventory. And then 2, exclusively and regularly as a place where you meet or deal with clients or customers in the normal course of your business. 3, in the case of a separate structure which is not attached to your home in connection with your business. 4, on a regular basis for certain storage use. 5, for rental use, or 6, as a daycare facility. Exclusive use. To qualify under the exclusive use test, you must use a specific area of your home only for your trade or business. The area used for business can be a room or other separate identifiable space. It does not need to be marked off by a permanent partition. You do not meet the requirements of the exclusive use test if you use the area both for personal and business purposes. There are, however, 2 exceptions to the exclusive use. One is if you use the part of your home in question for storage of inventory, or 2, you use the part of your home as a daycare facility. To qualify using the storage of inventory, you must sell products in your business, keep the inventory in your home for your business. Your home is your only fixed location of your business. The storage space is used on a regular basis, and the space is separately identifiable space suitable for storage. Regular use. To qualify under the regular use test, you must use a specific area of your home for business on a regular basis. Incidental or occasional business use is not considered regular use. Principal place of business. You can have more than one business location, including your home, for a single trade or business. To qualify to deduct the expenses for the business use of your home under the principal place of business test, your home must be the principal place of business for that business. There are a number of things to consider to meet this test, which we don't have time to discuss today. If this situation applies to you, discuss your situation with an experienced tax professional. Figuring the deduction. There are 2 methods to figure the deduction. The first one is the simplified method. Under the simplified method, you calculate $5 by the area of the home used for your business at a maximum of 300 square feet. The second method involves calculating direct expenses that are 100% deductible and used only for that space, and then indirect expenses based on the square footage percentage of business use. You cannot deduct expenses for the time you did not use your home for business. So for example, if you didn't start using that until March, you cannot include any January, February expenses in the calculation. To calculate the percentage, you divide the area of your home used for business by the total area of your home. You would apply this percentage to the following expenses: casualty losses, mortgage interest or rent, real estate taxes, insurance, repairs and maintenance, utilities such as gas, electricity, trash removal, security system, and cleaning expenses. You can also deduct depreciation of your home, but you must subtract the land cost from your home cost because land is not depreciable. Your deductions for business use of home may be limited if you don't have sufficient income, in which case it can be carried over to the next year. As always, I recommend an experienced accountant to assist you with the home office deduction, as it can become complicated.
Like most things we're finding here is there's a simple method and then there's a more involved method. But it looks like getting the help of a professional is probably the best for most people as they try to wrap their head around which one's best for them and their situation.
Right. So they have a lot of rules, and of course rules have exceptions, and as the IRS always likes to have exceptions on their exceptions. So making sure that you're calculating it correctly and that you actually qualify to use it.
Now here's a big one that all of our affiliates are aware of: sales and use tax compliance. We know that there's been a number of changes here over the last few years with the South Dakota versus Wayfair ruling that came down, and sending shipping items out of state and collecting sales tax on that. So we're going to talk a little bit about those and kind of get some clarity on when and where and how, and as much as we can, because we know this is a very deep topic as well.
Yeah. So far, everything that we've discussed so far has been all federal IRS rules. So now we're switching things up a bit and discussing a state tax and everyone's favorite, sales and use tax. So just to be aware, every state is different. So what is taxable in one state may not be taxable in another state, or they may also have another name for it. Some states call it gross receipts tax instead of sales and use tax. With the 2018 U.S. Supreme Court ruling of South Dakota versus Wayfair, the Supreme Court decision eliminated the requirement that a seller have a physical presence in the taxing state to be able to collect and remit sales tax to that state. This expanded the state's abilities to collect sales tax from e-commerce and other remote transactions. The term nexus is now a concern for those who sell items to residents or businesses in other states. One does not have to actually be in that state. Shipping to that state applies for the term nexus. The term nexus is the dollar amount and or the number of transactions threshold to obtain nexus status. Some states have $100,000 or more, or 200 transactions. Some are both, some are or either one. Some take into consideration the previous year's sales and or transactions. Each one has different threshold. So it's important to keep track of each state individually. It's way too complicated to go into more detail in this webinar, so I will just leave it at that. This is a service I do provide, so if you are interested, you can contact me and we can talk about it. The next topic I will discuss is use tax, because that is a little bit more simple.
Cinda, if you don't mind, I just want to touch a little bit on that as well. I know it's been a big topic for a lot of our affiliates as far as sales tax and out of state. So the important thing there is that there are thresholds that they need to meet before they need to start collecting and remitting to, say, North Dakota. And that's based off of the dollar amount of sales that they've done and shipped to that state, or the amount of transactions themselves.
Right.
And the tricky part with this is that it's different from state to state. So what's in North Dakota, as far as the nexus, is going to be different than South Dakota and Iowa and Wisconsin and everywhere else.
Correct.
Luckily, most of our affiliates are probably underneath the thresholds for sending that dollar amount or that amount of transactions, but we just want to make them aware that that is something that they will need to track if they feel like they're getting, or they know they're getting close to those thresholds, because you may be eligible to submit sales tax in a North Dakota or in Iowa if you hit those thresholds.
Yeah, so some of the states, they have either a dollar amount or a number of transactions as a threshold. Usually most of them, but not all, are around the 200 transaction amount. So one thing I would caution your affiliates, if you are charging your customers that you're shipping to, if you're charging them for their invoice amount in one transaction, and then after you figure out your shipping, then also charging the shipping in a separate transaction, that may be construed as 2 transactions for that state. So if you want to try to keep your threshold down, or the number of transactions down, you may want to consider only charging the customer once you figure out your shipping, and then include the whole entire total for their invoice and the shipping and handling charges as one transaction, and only swiping that card once versus 2 times. So that might be something to think about.
Yeah, and unfortunately, it's probably not written in stone as far as how they perceive a transaction. So it's probably based on the feeling of the auditor that day, as far as if it constitutes 1 transaction or 2. Another question I would have is, so if I'm under that nexus threshold and I'm shipping to North Dakota from Minneapolis or wherever in Minnesota, do I charge any sales tax before I hit that threshold, or do I just charge no sales tax because I haven't hit the nexus and it's going to North Dakota?
So, yep, so I'll talk about a little bit about that in a little bit, but that's a good question. So it's Minnesota is location based. So if you are an auction company in Minnesota, or if you're doing an auction, it's wherever they pick up that merchandise.
Mhm.
So say, for example, you're doing an offsite auction, like say maybe you're normally in Minneapolis, but you're doing an off-site auction in Staples and your customers are picking up those items in Staples, you're
Mhm.
going to charge the sales tax rate applicable to Staples.
Yep.
Or wherever that location, that address is.
Mhm.
Or vice versa. If you're normally in Staples and you're doing an auction down in Minneapolis, you need to charge the Minneapolis tax rate.
Yeah.
And oftentimes you can't even just use the zip code. It's the zip code +4 that you need to use, because there is also transit taxes, county taxes, city taxes, etc. And it's really based on the zip +4.
Mhm.
So it's
Yeah, and
location based. So to answer your
looked up.
question, if
Go
you're
ahead, sorry.
shipping to North Dakota, then no, you do not have to charge any sales tax if you're under the Nexus
Mhm.
amount, for that state.
Cool, great. I know I've looked up the Minnesota sales tax calculator many times and put in that the zip code +4 to figure out exactly what it is, and it's a nice tool. It gives you exactly what you need to know.
It is. Yep. I encourage all auction companies to use that when they're shipping out items to get the actual tax rate. So yeah, and then if you're shipping, to say the auction is in Minneapolis, but you're shipping to Staples or St. Cloud or whatever, you're going to use the tax amount for the shipping address.
For the location of the buyer, where it's being
Right.
shipped to.
So where they're receiving the merchandise. So whatever the ship to address is.
So they just wanted to make it really easy for small businesses to be able to collect and submit sales tax, huh?
Oh yeah, yeah. They're not known to be going easy on businesses, that's for sure. They like to mix things up a bit and make things a little bit complicated.
Right.
So
I'll let you continue.
Sure. So I'm just going to talk about use tax really bit, because not everyone has heard that term, or they might have heard about it and they don't know what it is. So use tax comes into play when a business buys a product or a service that is taxable in the state, but the seller, for whatever reason, does not charge sales tax. You, the business, is then required to pay a use tax on that item to your state. Again, some states may differ, and some states this also applies to individuals, not just businesses. In Minnesota, it only applies to businesses. As an individual, they do not require a use tax, although there might be some exceptions to that too. But generally speaking, as an individual, you don't have to worry about it. But as a business, you do in Minnesota. So I am speaking specifically about Minnesota, but other states have the same general rule. Be sure to check the rules in the state that you are located. So I'm going to use an example. So if you purchase office supplies from an online retailer and they don't charge you use tax or sales tax, excuse me, you would then be required to report and pay use tax on that particular order and any other orders that would also be taxable when you file your normal sales and use tax return. So you file and pay at the same time you file your sales tax return. That's why it's called the sales and use tax return. So it's pretty simple in Minnesota for use tax. Basically, if you didn't pay it and it's supposed to be taxable, then you owe use tax on it as a business.
So it's important to keep those receipts on business items that you're purchasing, and then to verify, was I charged sales tax or not?
Right, because they will check for use tax as well if you're ever involved in a sales and use tax audit.
So there are some things like software that maybe wouldn't apply, or subscriptions that may not apply to that.
Minnesota is very, there's a lot of exceptions on their software that you purchase. So if it's considered a subscription-based software, then it's not taxable. But if you buy it online and download, and there's a few other ways that they word it, then it's considered taxable. It's just, and you have to look in on all kinds of different fact sheets to figure out exactly when it's taxable or not. It's just crazy. So it can depend on how you have the use of it, basically. So yeah, it's crazy how complicated they make something as simple as software, whether or not it's taxable or not taxable. So
kind of what I figured.
Yeah. So let's move on to taxable sales as an auctioneer. So everything I'm going to discuss is Minnesota rules regarding sales tax. Other states may have similar rules or they may have different rules. So this is Minnesota only. So I'm going to start out with what is tax exempt as far as items in the auction. Sales of tangible personal property that are primarily used in a trade or business are exempt from sales tax if the sale is not made in the normal course of business of selling that kind of property and one of the following conditions are met. One, the sale is a sale of substantially all of the assets of that trade or business, and they define substantially as 90% or more of the total fair market value of the tangible personal property of the trade or business is sold, and all of the assets are sold within a 12-month period beginning on the date of the first sale of the assets. The sale of substantially all of the assets can be a single transaction or a series of related transactions taking place within a 12-month period. Sales of assets after the 12-month period are subject to sales or use tax. So if you are liquidating a business that went out of business and you are selling substantially all of the assets of trade of the business, those potentially could be exempt from sales tax. Number two, the total amount of gross receipts from the sale or trade of trade or business property made during the calendar month of the sale and preceding 11 calendar months does not exceed $1,000. Third one would be the sale of farm machinery. Fourth is the sale of a farm auction. A farm auction is defined as a public auction conducted by a licensed auctioneer. Substantially all of the property sold consists of property used in the trade or business of farming, and non-business property such as household goods can also be included. Estate sales. An estate sale is a sale or auction of someone's household goods. The property is usually a collection of household goods such as furniture, jewelry, clothing, etc. When household goods are sold at an estate sale, the sale is a non-taxable, isolated, or occasional sale if no business assets or inventory are sold, and if all of the following conditions are met. The title is exchanged directly between the owner of the property and the buyer of the property. And second, the seller does not carry insurance on the property. So that would be you, the auctioneer, do not carry insurance on the property. And three, the seller and owner of the property to be sold have entered into a written agreement. A consignment auction or a consignment sale is taxable. A consignment auction is defined as regularly scheduled events that are open to the public to sell their items. These auctions are held at the same location. Consignment auctions are not tax exempt as the auctions previously described. If a seller consigns household goods or makes estate sales at a selling event, the sale of taxable items are taxable. If the sale is taxable, the person collecting the payment is responsible for charging the tax on the sales price of the property, such as an auctioneer. So if you're collecting the payment, the auctioneer is responsible for collecting and remitting that sales tax. And as we've already discussed, when collecting sales tax, location matters. Locations can have state, city, county, transit, and other rates applicable to the sale. make sure you are charging the correct rate. In Minnesota, you will charge sales tax based on the location your customer picks up the merchandise, or if it is shipped, the address it is shipped to. So if you do shipping, you'll need to know the sales tax rate the items are being shipped to. Oftentimes, as we already discussed, you need the zip code +4 to get the correct tax rate. Delivery and shipping charges are also taxable unless the items purchased are all non-taxable. So I do specialize in sales and use tax compliance. So if this is a service that you think you may need help with, you can contact me or contact another professional that specializes in sales and use tax.
I'll chime in. When we were managing auctions ourselves internally at KBID, you heard a lot of ifs and ors and ands, and there's a laundry list of reasons why you can and why you can't. For us, that was very ambiguous depending on the situation. So we erred on the side of charge sales tax because, again, it's ambiguous and it's not necessarily black and white as is this taxable or is this not, based on that situation. So as a company, we made that decision to err on the side of most things are taxable because you just didn't know 100% if that fell under the guidelines of some of these exemptions, like a single seller estate liquidation or a business where you're selling substantially all of the assets. Well, what if 3 weeks ago before I got here, they sold a $500,000 piece of equipment? Now I don't know if I'm selling substantially all of the assets to that business. So do I fall under this? There's a lot of ambiguity there to us. And honestly, we've found and seen that, buyers aren't necessarily taking sales tax. They just expect that. So for us, it was, we charge sales tax. The buyers would provide us with that ST3 form to prove that they were tax exempt, and that would take the responsibility off of us. And then we would just staple that to the invoice and file it away with our auction. So in the case of any audit, that we can prove that the buyer said they were tax exempt, and here's the form that they provided to us. So that's how we handled it, just to chime in on, some of these exemptions and some of these things that I know people are well aware of.
Right. Yeah, you bring up a good point. If you're unsure, it's always best to err on the side of charging the sales tax, because if you do get audited and the state of Minnesota says, yep, you should have charged sales tax on that money is going to be coming directly out of your coffers. You're not going to be able to go back to your customers and say, oops, we forgot to charge sales tax. Now we're here to collect. No, you're going to end up paying that. So if you're not 100% sure, collect the sales tax and remit it, and then you're safe. And that's just a good guideline to go by. So, and then I didn't talk about the ST3. I'm glad you brought that up too. Open, I don't know why I have W9s on there. Sorry. That's the ST3 is actually the correct one to look at. So sometimes you'll have buyers that are resellers, and they will give you what's called an ST3. And basically it's a form from Minnesota that resellers can give you that, because they're tax exempt. So they're going to purchase items from you. They're not required to pay sales tax at the time of their purchase, because they are going to collect the sales tax when they resell that item. So so sometimes companies or people that are resellers will give you an ST3, and that, as long, just staple that to your invoice like Chris said, and then you're good to go. You don't need to charge that particular person or company, whatever, sales tax. So I'm glad you brought that up, because I totally didn't talk about that at all. So,
well, we could talk about sales and use tax all day, but quite frankly, I don't want to. So let's move on.
Yeah, so let's do that. Now let's talk about payroll and employee considerations. So this is a question that is asked a lot. How, as an owner, do I get paid? So the answer for that question lies in which type of tax entity the business is formed under. If your business is a sole proprietorship, then the business owner can take withdrawals from the business whenever he or she wants. You are not put on payroll. Your business is taxed on the net income of the business, and the withdrawals are not considered an expense. Therefore, they do not come into play. So you can write yourself a check out anytime you want, as long as you got money in that account. If the business is an S Corp, however, then owners must take a reasonable salary. In addition to the reasonable salary, they are also able to take, distributions exempt from payroll taxes. They cannot take distributions in lieu of a reasonable salary. So if you are an S Corp, you do have to take a reasonable salary if you are an employee working within the company. The IRS does reserve the right to recharacterize distributions paid to a shareholder as salary if the distribution was paid in lieu of a reasonable compensation, or if they determine that the reasonable compensation was not reached. The ability to take distributions exempt from payroll taxes is one important but not the only reason for choosing an S corporation over the other types of entity choices. A sole proprietor pays self-employment tax on all of its taxable income, whether or not it is distributed to the sole proprietor. Whereas an S Corp, the S Corp and the employee pay their part of the payroll taxes on their reasonable salary.
Mm-hmm.
Let's talk about independent contractor versus employee. To be a bona fide independent contractor, the hiring company cannot control the details of how the services are performed, only its final outcome of the services. The general rule is that an individual is an independent contractor if you, the person for whom the services are performed, have the right to control or direct only sorry about that. I lost my place on my notes. Have the right to control or direct only the result of the work and not the means and methods of accomplishing the result. Independent contractors generally offer their services to the public and are registered as a business. If you have control over the person, including control of the schedule, how the work is done, where it is done, which tools or equipment to use, who to hire to help or assist, which supplies to use, etc., that person will be considered an employee. The amount of time or the amount of money paid has no bearing in whether they are an employee or an independent contractor. They could have worked for you for only 15 minutes and still be your employee. The amount of control is the deciding factor of an independent contractor versus an employee. Let's talk a little bit about family members as employees. Payments for the services of a child under age 18 who work for their parent in a trade or business are not subject to Social Security and Medicare taxes if the trade or business is a sole proprietorship or a partnership in which each partner is a parent of the child. In addition, a child under age 21 who works for their parent, whether or not in a trade or business, are not subject to the FUTA tax. The wages are still subject to income tax withholding unless the payments are less than $50 in a quarter or the child isn't regularly employed to do such work. Spouses and parents employed by their child. Wages of an individual who work for their spouse or child in a sole proprietor trade or business are subject to income tax withholding and Social Security Medicare taxes, but not to FUTA tax. There are no payroll tax exemptions for family members when the trade or business is a corporation or a partnership where only one partner is a parent. There are a number of payroll taxes and reporting that must be done when you have employees. All employers must have an EIN called the Employer Identification Number. You'll need to register with the state, and you'll also need to get a state tax ID number as well. The EIN is IRS or federal. Each new employee must fill out a Form I-9 employment eligibility verification. They also need to complete the federal Form W-4, and Minnesota also has their own form called Form W-4MN so that you can accurately calculate withholding taxes. You'll need to report all new hires and rehires to your state new hire reporting website. In Minnesota, you need to report within 20 days from the date of hire, and all states do have a new hire reporting website. There are 6 main payroll taxes, and depending on the state, there may be others. So we're going to talk about the federal taxes first. Social Security. Both the employee and the employer must pay 6.2% of all wages, up to a wage base rate of $160,200 for tax year 2023, for a total combined rate of 12.4%. And the wage base rate generally goes up a little bit each year. But I'm going to assume that most of you probably that will not be applicable to. Medicare, again, both the employee and the employer must pay 1.45% for a combined tax rate of 2.9%. There is no wage-based limit for Medicare. Federal income tax withholding. This is the amount of income tax you are withholding and submitting on behalf of your employee that goes towards payment of their income tax return. These are withheld from the employer, from the employee. The employer does not pay anything for federal withholding. These 3 taxes, Social Security, Medicare, and federal withholding, must be paid electronically through the EFTPS system, and schedule depends on the dollar amount due. But day, semi-weekly, monthly, or quarterly. And again, it depends on the dollar amount due. Most of you will not be next day. You may be semi-weekly or monthly, however, or quarterly. The tax returns are due either quarterly, or if you are a very small employer, it will be due annually. Okay, let's talk about state withholding. As with federal, you are also required to withhold income tax for the state, and this is paid by the employee. Not all states have income tax, so again, this is state dependent. Amount withheld depends on their taxable wages and their number of allowances. In Minnesota, there are 2 deposit schedules, semi-weekly and monthly. When you deposit depends on the dollar amount due, just like federal. Most employers are required to file the withholding tax returns quarterly. In conjunction with FUTA, state unemployment systems provide for payments of unemployment compensation to workers who have lost their jobs. SUTA, or unemployment insurance tax, is a state unemployment tax paid by the employer, so it's by you, the company. Unemployment insurance is required in all states. The tax rate depends on your experience rating and the type of business work that you do. New employer rates in Minnesota start at 1.00% and go up to 8.9%. Returns and payments are due quarterly. To find out more information about your state, go to oui.doleta.gov//unemploy, UNEMPLOY/agencies.asp. Or you can email me and I can send you a link. FUTA is federal unemployment insurance that is also paid by you, the employer, and is required if you pay wages of $1,500 or more in any calendar quarter in 2022 or 2023, or if you had 1 or more employees in any 20 or more different weeks in 2022 or 2023. 2023 FUTA rate is 6.0% for the first $7,000 in wages. But if you pay your state unemployment insurance payments on time, it is reduced to 0.6%. For deposit purposes, figure your FUTA tax quarterly by using the 0.6% on the first $7,000 of wages of each employee. When total liability is over $500, you must deposit by EFTPS by the last day of the first month that follows the end of the quarter. The FUTA tax return, however, is due annually. Work comp. Work comp is not a tax, but it is an insurance in case your employee gets injured on the job. Work comp is required in all states except Texas. Requirements vary by state, so search your state's requirement to see when work comp is required for you. Work comp premium is dependent on the dollar amount of your payroll and also the job classification of your employees. So unless your payroll is very small, do expect to have a work comp audit each year. That is not the same as a audit by the state or federal. It's just by your insurance company, so you don't need to be scared about it. Most but not all states also have other employer responsibilities, such as disability insurance or paid time off. In Minnesota, effective January 1st of 2024, Minnesotans time law requires employers to provide paid leave to employees who work in the state. Minnesota's current sick and safe leave law remains in effect until December 31st of 2023 and will be replaced by the new earned sick and safe time law on January 1st, 2024. An employee is eligible for sick and safe time if they, 1, work at least 80 hours in a year for an employer in Minnesota, and 2, they are not an independent contractor. So if you have an employee that works 80 hours or more in a year for you, then you will be required to have the paid, the earned sick and safe time law will apply to you. Temporary and part-time employees are eligible for sick and safe time. An employee earns 1 hour of sick and safe time for every 30 hours worked and can earn a maximum of 48 hours each year unless the employer agrees to a higher amount. Sick and safe time must be paid at the same hourly rate an employee earns when they are working. Earned sick and safe time local ordinance already exist in the cities of Bloomington, Duluth, Minneapolis, and St. Paul, Minnesota. When Minnesota's statewide earned sick and safe time law goes into effect on January 1st, 2024, employers must follow the most protective law that applies to their employees. And then the second one that just was passed recently is the Minnesota's paid family and medical leave law, which provides paid time off and then goes into effect on January 1st, 2026. Paid family and medical leave is a new program launching for Minnesotans in 2026. It provides paid time off when a serious health condition prevents an employee from working, when they need time off to care for a family member or a new child, for certain military-related events, or for certain personal safety issues. And there are 2 main types of leave under this law. Family leave to care for a family member with a serious health condition, or if they're bonding with a new baby or child in the family, and medical leave when an employee's own serious health condition prevents them from working. The paid family and medical leave premiums will be 0.7% of an employee's taxable wages. Employers, however, may charge a maximum of half this premium, 0.35%, to their employees through a wage deduction. Paid family and medical leave premiums will be collected starting January 1st, 2026. The paid family and medical leave program will have an employer account system where you will manage your premium payments. MDEED will update their website with more information as we get closer to the program's start date. Employers will have several important responsibilities in the paid family and medical leave program. Starting in mid-2024, most Minnesota employers will be required to submit a wage detail report, which will detail the quarterly wages received and hours worked for each employee. Starting in late 2025, employers must notify their employees about this program. The paid family and medical leave program will provide language for this notification. Starting in January 2026, Employers will also be required to submit any premium payments due. Visit your state's Department of Revenue and Minnesota Department of Employment and Economic Development site for more information.
Well, I mean, that's enough information there that would maybe encourage someone to get a payroll partner or someone to help with payroll, because there's just a lot to take in there, especially with the new PTO requirements and family medical leave, all that stuff that's coming on board. One thing I really wanted to touch on, which I know impacts a lot of affiliates, is that difference between an independent contractor and an employee. And quite frankly, it's pretty uncommon to have an independent contractor working with you or for you. It's most likely an employee situation where you're telling them when to show up, what they need to do, how long they have to do it. And, you know, some of the ramifications of that are serious. And, you know,
Yes.
We have a real life example. There was someone working for an affiliate in the last couple of years. They were an independent contractor, or so they thought. They ended up getting hurt and they didn't have any workers' comp. The person was severely hurt, had to go to the hospital, was out of a job for a while, was laid up, and they sued because they weren't eligible for workers' comp, and they won. Because that that worker was classified as an independent contractor instead of an employee, where if they were an employee, they would have had workers' comp. As an independent contractor, they do not. So that's a real life story of something that happened in the last few years here locally. So it's really important to know what the difference is, and how rare actually an independent contractor is in most situations, and that most people would probably be classified as employees if you're giving them any direction, you know, if you're telling them what to do or where to go or how to get the work done. If they're freelance and they're just working on their own hours and they're just giving you the end product, then yeah, that probably does count as an independent contractor. But just be very careful as to how those are classified, because it can have some pretty big ramifications if done incorrectly.
Correct. Yeah, you're absolutely right. So you brought up very good points.
Mm-hmm.
So, and then the IRS and the state can also go back to you for those payroll taxes as well.
Mm-hmm.
So,
yep.
So yeah, there's lots of ramifications that can occur if you don't properly treat someone with the appropriate classification.
Correct. Yeah. All right, 1099 reporting.
Yeah, fun.
Another big one.
So I know this has asked a lot too. So when is a business required to do 1099 reporting? There are many instances when a 1099 report is required, but I'm only going to discuss the reporting requirements that would be applicable to an auction business. A business is required to issue annually by January 31st a 1099 return to the individual or business in which you paid $600 or more during the calendar year for services received and for rent payments. You are also required to report all 1099s issued to the IRS by February 28th. Generally speaking, payments to corporations are not reportable. However, you must report payments to corporations for the following payments. If they are a medical and healthcare payment, barter exchange transactions, cancellation of debt, payments of attorney's fees and gross proceeds paid, merchant card and third-party network payments, and others, but they are not applicable to auctioneers, so I will not discuss them. Reporting is generally required for all payments to partnerships. For example, payments of $600 or more made in the course of your trade or business to an architectural firm that is a partnership are reportable on Form 1099 miscellaneous. When paying rent or to a trade or subcontractor or other business that provides services, you must obtain a W-9. The W-9 will give you the reporting information needed so that you can file your 1099 at the end of the year. If the company is a corporation and does not meet any of the reporting for corporation requirements, you will not need to issue a 1099 for that company. However, do hold on to the W-9 for your records. If a company provides both services and materials, For example, a plumbing company who makes repairs and also installs or replaces some fixtures, the labor part of the invoice is reportable if the total is $600 or more during the calendar year. Again, unless it's a corporation. My advice is to always call the company or individual performing the services and request a W-9. Tell them that you are required to have it on file before payment can be made on the invoice. If you do this the first time before sending payment, your collection rate will be pretty high and should be 100%. Payments to consignors are not reportable on 1099 miscellaneouses as they are not providing services to you. In fact, if the consignor is a business, they should be requesting a W-9 from you, and if you are not a corporation and $600 or more in consignment fees were paid to you, they should be issuing you a 1099 by January 31st, even though the payments are backwards from a typical payment process because you're sending them the payment versus them sending you a payment.
That gets confusing a little bit.
It does, yeah.
Yeah, it's good to put it that way. And I've told people that before, that, if anyone should be issuing a 1099, it's the consignor to us because, I mean, they're paying us over $600. Yeah.
Yep, you are performing the service to them. 1099-K reporting. I know this is a big one now that people are talking about. So third-party settlement organizations called TPSOs are required to issue Form 1099-K to sellers of goods and services on their platform. A TPSO is the central organization that has a contractual obligation to make payments to participating businesses. Generally, a TPSO serves as an intermediary by settling payments between businesses and purchasers. TPSOs are required to issue a 1099-K at year end, summing the total monetary value their users received so that sellers of goods and services can report the stated amount as income on their tax return. In defining a TPSO, the IRS does list an auction house as an example. An auction house connects buyers and sellers of services and in return takes a small fee. According to the IRS, understanding your Form 1099-K, 1099-K reporting is required for payments of more than $600 to an individual or business during the calendar year from payment apps or online marketplaces. In other words, third-party payment networks. They define online marketplace as an online marketplace which resells clothing, furniture, and other items. An auction site, a freelance marketplace, among a few others such as craft or maker marketplaces, such as Etsy. I personally called the IRS to get clarification on this, and according to the IRS agent I spoke to, it only applies to digital payments made on an online marketplace, not cash or checks. And this ruling is intended to be applicable to online marketplaces like eBay and Etsy. I specifically asked about online auctions, and he said he couldn't tell me yes or no, but he didn't believe it to be their intent. He advised that businesses must make a business decision on whether to file the 1099-Ks, and if they're wrong, the IRS will let you know. So it's quite ambiguous, and you'll need to make your own decision on whether or not to issue 1099-Ks to your consignors when the payments are greater than $600 of digital payments, credit card payments. However, since you are the one collecting the payments, not KBID, that makes it two-party, not third-party, as in the definition. So I personally at this time would feel okay in not issuing 1099-Ks to any of my consignors. But again, that's a business decision that you need to make on whether or not you're going to issue the 1099-K.
Yes, and this is something we're watching very close, obviously. We don't believe, as far as how it's written now and what we've heard, that consignors of affiliates would fall under this category where they need to be receiving these 1099-Ks. And actually the NAA, the National Auctioneers Association, as well has written to the IRS to try to get something concrete in stone. They initially said, no, that's not the case. And then I think they walked that back. So it's still even, more ambiguous at this time. So I guess my messaging from KBID is that it's something we're certainly going to be watching for and trying to get as much clarification on as we can. But I think as we've seen, nothing tends to be black and white.
Right.
A lot of new laws are being pushed through, the ramifications of which you don't really find out until a couple years down the road. So we will certainly be watching for that, and whatever information we have or we get more clarity on, we'll be passing over to affiliates as well. But that's our understanding is the same, in that, you know, we are not a traditional marketplace, and that we're not collecting all the payments for affiliates and then sending them, you know, the money, and that their consignor should not fall under that category of receiving the 1099-K. But again, we are not attorneys, so do your own best judgment. It is a business decision that you have to make, but that's our understanding at this point.
Yep. So, yeah. Then the next thing I want to briefly talk about is reporting cash payments of over $10,000. Just as it sounds, any person in a trade or business who receives more than $10,000 in cash in one or more previously unreported payments that cause the total cash received in a 12-month period to total greater than $10,000 must file Form 8300 with the IRS within 15 days from the time the payment was received that would total greater than $10,000. The definition of cash includes cash, obviously, but also includes cashier's checks, bank draft, traveler's check, or money order when individually under $10,000, but all transactions combined total $10,000 or more. It does not include a check from a personal or a business checking account because the banks will already file those. For more information on this, read the instructions for Form 8300, which can be found on the IRS's website.
I know that bankers are more than happy to help you with some of that too. You know, especially if you're depositing large amounts of cash, there's different things that you'll be required to do, and that all comes down to money laundering and preventing that, which makes sense. So,
right.
Good to touch on.
Yep.
All right, so I think we've learned a lot as far as why we need to collaborate with a professional. But why don't you just touch on, you know, remind us again why why it's so helpful to get someone who knows what they're doing on each of these aspects to keep us in line.
Sure. So it offers several benefits for businesses, and I'll just talk on some key reasons why a business should consider working with an accountant. Number one is financial expertise. Professional accountants possess specialized knowledge and expertise in managing financial matters. There is a reason why it takes 5 years of college to become a CPA. They can help businesses understand financial concepts, interpret financial statements, and make informed decisions about budgeting, taxation, and financial planning. When choosing an accountant, look for someone with at least a bachelor's degree in accounting and several years of real-world experience. There are too many bookkeepers out there that do not have the knowledge or experience to properly do your bookkeeping. Quality isn't cheap, and cheap isn't quality. Starting with cheap can cost you much more down the road in messy cleanup costs and amended return costs. Number two, compliance and reporting. Tax laws and financial regulations are constantly evolving. An accountant can assist businesses in staying compliant with these regulations, filing accurate tax returns, and avoiding penalties or legal issues. Third, financial analysis and performance evaluation. Accountants can analyze financial data, track key performance indicators, and prepare meaningful reports. They help businesses understand their financial position, identify trends, and make informed decisions to improve performance, cut costs, or allocate resources effectively. Fourth, financial control and risk management. Accountants play a crucial role in establishing strong financial controls within a business. They can design and implement internal accounting systems to monitor cash flow, track expenses, and reduce the risk of fraudulent activities. Additionally, accountants can assess business risks and advise on risk management strategies to protect the company's financial interest. 5, cost savings. A skilled accountant ensures your books are accurate from the start, avoiding messy and costly cleanups and amended tax returns down the road, and can also help you avoid paying penalties, late fees, etc. They can identify opportunities to minimize costs, improve your cash flow, and maximize your profits. They can analyze the financial data, identify areas of inefficiency, and suggest strategies to streamline your operations and reduce unnecessary expenses. By providing insights into the financial health of the business, accountants can contribute to long-term financial success. 6, time efficiency. Managing financial tasks can be time-consuming for business owners and staff, especially if they lack the necessary expertise. By collaborating with an accountant, businesses can offload financial responsibilities and focus on their core operations. This allows a business to operate more efficiently and enables key personnel to concentrate on their areas of expertise. Overall, collaborating with a professional accountant can provide businesses with the financial expertise, compliance assistance, cost savings, and strategic guidance necessary for sustainable growth and success.
Mm-hmm. I think it comes down to the old saying, if you think it's expensive to hire a professional, wait till you hire a novice and then see what happens, to fix all those errors. And that comes down to any business and, even auctions too, like, hiring people who have experience and who've seen it and know it.
Right.
It can save you much more in the long term when you're thinking big picture.
Absolutely.
So I agree completely. Well, I think you've answered a lot of the questions that we had, a lot of the questions that affiliates have right now. I did want to leave them with information on how to get a hold of you at Booked and Balanced Accounting. Again, Cinda, we thank you for joining us. Your website here, bookedandbalancedaccounting.com, ACCTG.com, and then your email there as well. I'll have this information when we send out this video available too. So I know that you're available if anyone wants to do a walkthrough or a 15-minute consult with you to talk over any of those, or maybe their situation, and see if your services could help them out.
Sure.
So we thank you again for all the information, all the knowledge. We know there's a lot here. We're just kind of scratching the surface, but I think it'll get people starting to think about, how am I reporting financially? How am I seeing where I'm at? Or am I filing my sales tax correctly? So we thank you again for the time, and we will send out your information to affiliates, and if they have any questions, they can reach out to you.
I appreciate that, Chris. Thank you.
All right. Thank you.